ladies and gentlemen, it's Modern Investing on Pod TV. My name is Sasha Starr, and we have today Dr. Milan Sambarak. Welcome to the show, Milan, and Jim Eat from Eat
Thank you for
Foundation.
inviting me. Delighted to be here.
Jim, welcome to the show. Great
Thank
to have you as
you.
always.
Great to be here.
Okay, so today is Wednesday. It's normally market is up 500 or maybe 1,000 points. It's not story today, but at least it's not down significantly. And everything is intact. Nvidia slightly down. Actually, very interesting point on Nvidia I'd like to make. Yesterday, Nvidia was up $10 a share. That's okay, good move. Still far from $500 where it should end this year in any case. But what's happening today on a pre-market, Nvidia was very strong, up $4 or $5 a share, if not more. So a lot of seems to me a small trader, day traders, the people who were enthused about yesterday's move, they wanted to make some extra money on that, and of course jumped and buying shares. And I noticed I was watching the trades, very small trades. Somebody bought one share, somebody bought three shares, somebody bought 7 shares, 10 shares here and there. And the market opened, and there were three significant down moves. One stayed there for a little while, maybe 15 minutes. Another moved down to 2.5 points. Stayed there. Oh, these people already sold because they had stop losses. So they bought at $5 up on pre-market. So they lost $5. They lost another $5 later on. Okay, it's time to run. Okay, oh, you're still there? Hey, another move down. Oh, okay. Now there's a pain. So what you do? Well, all we need is to move it a little bit higher, and then I'll get out. Okay, I'll lose a little bit of money. Oh no, it's gonna be down another $1.50. Well, at some point people will have to give up. I think Nvidia will go down today, probably $8, maybe $9 down. So plus $5 on the pre-market, so people will lose $14 a share or so. And so the house market makers like Goldman Sachs and many others, they will be very, very, very happy. And tomorrow Nvidia will go up $20. It doesn't matter. People today who on the pre-market were trying to make some money, they will be wiped out. And this is a classical market story. This is how market makers are making their money. This is how they very cleverly separate investors with their money. And it going on and on all the time, every week, every month, every year. There is a lesson to be learned. I don't trade on pre-market or aftermarket. It's very thin trades. They're not indicative of anything. It's just like a playing with the small traders. Okay, here we are. Okay, we are open. Oh, you want to make money? Okay, you buy Nvidia, $5 over yesterday's closing. Oh, okay. Well, now the regular hours, stock immediately down, and well, you may say that, well, it's random moves of the market. But for some reason, this random move is on a way down, not on a way up. Is it random? I'm not so sure. Jim, what do you think?
Well, I think we should give Milan a chance to talk because Milan can't hear us. And so what I'm going to do is signal to him that it's his turn to talk. Milan?
Milan, we would like to start talking. Go. Milan, please start talking.
Yes, thank you for having me here today. I have a number of issues I would like to discuss. First of all, Charlie Munger died recently at age 99, and I want to quote a number of statements that he made that all of us should be aware of. He was very successful as an investor, As most people know, he was Warren Buffett's partner for more than 50 years. Berkshire Hathaway was a failing shirt making company when they took it over, and it wound up being one of the most successful investment operations in history. And so Charlie Munger said, the game of life is a game of everlasting learning, at least if you want to win. That's what it should be. So he stated, develop into a lifelong self learning through voracious reading, cultivate curiosity, and strive to become a little wiser every day. Spend each day trying to be a little wiser than when you were when you woke up, day by day. And at the end of the day, if you live long enough, like most people, you will get out of life what you deserve. Um, I have a picture of an owl catching a mouse because it eats what it hunts successfully. That's not the case on Wall Street. Many people on Wall Street make much, much more than they have ever earned. So I keep saying all the time that Wall Street is not our friend. We need to have Wall Street in order to complete our transactions, but they're not our friend. And as Smith wrote a book called Why I Left Goldman Sachs some years ago. He wrote the book, and the reason he left Goldman Sachs, stated, is that the money managers there call their clients Muppets. Muppets are incompetent people. They call them Muppets, and in all the meetings, they spend their entire time discussing how they can get more money from Muppets. Didn't spend 1 minute talking about how they can help their clients make more money. So he felt that was not sustainable, and so he left. Now, another thing that I think is important is that, 1776 is celebrated in the United States as the official beginning of the nation with the Declaration of Independence, the 13 colonies, independence from the British Empire. So 1776. What could be even more important took place in 1776 was Adam Smith's The Wealth of Nations. Adam Smith, who said that it is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own self-interest. So it's useful to be aware of that. Now, the other thing that's useful to be aware of is that equaling the market, the United States market, Wall Street, New York Stock Exchange, is very simple. All you have to do is buy an exchange-traded fund which tracks the S&P 500, which represent the 500 largest companies in the United States or on the planet, and which have outperformed, generally speaking, any other investment for over 100 years, close to 200 years. Yes, there are cherry picking. You can pick some real estate, for example. Vancouver has done better than the stock market usually. So has Toronto, so has at times San Francisco. But Case Shiller maintained a record of the home values of 20 cities in the United States, and the Case-Shiller index is about half as good as the S&P 500. And yes, it's possible to make money at times in San Francisco real estate, but for every San Francisco, there is a Detroit. For every Toronto, there is a Sault Ste. Marie. My wife and I were in Sault Ste. Marie a few years ago to watch the fall colors. In downtown Sault Ste. Marie, they have boarded up businesses. It doesn't say for sale or for rent, but boarded up. They still have to pay municipal taxes there. And so the real estate can work, as can many other things. I think I mentioned a friend of mine, a top-notch violinist, who bought a violin for the price of a Toronto house about 50 years ago, and he recently sold it for the price of 3 Toronto houses. $10 million he got for his Stradivarius. For every $10 million violin, there are thousands and thousands and thousands are worth a couple of $100. So that's useful to keep in mind. So we say to our members at Monday Morning Millionaire, about 300 members we have, The reason why we call the operation Monday Morning Millionaire is because many of our members who are either retired or close to retirement make more money on a Monday morning before breakfast than they ever did during their best week at work. And that's possible for everybody. However, the market does fluctuate as much as 30% in one year. So the money that we're going to need next week for groceries and if you want to buy a car or take a holiday, whatever it is, does not belong in the market. We should not have any money in the market that we're going to need for the next 2 or 3 years. In the meanwhile, whatever we have in the market will outperform, generally speaking, without cherry picking any other investment. The US market has given us about 6.5% annually, inflation adjusted, for over 100 years. And advisors suggest that we take out 4% annually of our portfolio to live on. If we be making more than 4%, making 6.25% annually, we can do very well by investing in the American market, not picking individual stocks. You know, there are four ways to beat the market. To equal the market, all we have to do is buy an exchange-traded fund which tracks the S&P 500. And SPY happens to be the best because it's the oldest and the largest and has the narrowest bid-ask spread. And so that's the place to be. So equaling the market is something that is simple to do. Just simply buy SPY and do nothing else. Four ways to beat the market. Number one is dollar cost averaging, but not an individual stock, because you could start buying Enron and Nortel and Pennsylvania Central Railroad and so on, which are just going to keep falling out of bed. And so dollar cost averaging there will destroy you. But dollar cost averaging, the American market has worked remarkably well, better than any other investment, and will continue to do that. So number one is dollar cost averaging the U.S. market, not an individual stock. Number two is share buybacks. When companies start buying their own shares for whatever reason, the price goes up because there are fewer shares outstanding out there. The company has been buying them. And anytime you have less of anything valuable, the price goes up. So that's a reliable way to beat the market, is when you have share buybacks. The other way to beat the market is to pick the right stock. And that doesn't work for most investors. Most investors do not equal the market. Most investors trail the market. So picking the right stock, whenever you buy a stock, you're buying it from someone who's selling it. Can both of you be right? Actually, it is possible for both of you to be right, and no need to go into that. But most of the time, that doesn't happen. If the stock goes up, the buyer is right, the seller is wrong. If the stock drops, the buyer is wrong, the seller is right. Both cannot be right. So if you are a market wizard, like Sasha Starr happens to be, you can pick the right stock. I have never been able to do that except with hindsight, so I don't even try anymore. I buy the American market as a whole. The government can't give us anything that they haven't taken away from us in the first place. But they can impose regulations such as taxation, let's say. And so in 2005, the Canadian government removed the foreign content limits in our portfolios, our tax advantage portfolios, allowing us to buy any security in any amount, which made it possible for us to buy the American market as a whole, which is where we should be, which is where our Monday morning millionaire investors are primarily, except occasionally when they buy a security because it's buying back its shares, buybacks. So that's what I have to say so far today. And I can read what you're saying. So carry on and continue here, and I'll participate to whatever extent I can be useful. Thank you.
Thank you so much, Milan. Okay, Jim, what's your perspective on the markets and how are you doing these days?
Oh, thank you, Sasha. I just sent a message to Milan to have him check his phone, so we both
Okay.
have messages for him. but these technical difficulties happen so often, and unfortunately, you can't hear us. Um, there's a few things that I would like to say about what Milan said. One was Adam Smith was talking about rational self-interest, and what I think we've learned over the course of the centuries is that it's our enlightened self-interest that we should follow. And we have Milton Friedman, who is a well-esteemed and very, very good economic theorist, but he didn't have the data that we have now. This is 50 years ago that he wrote about. The companies should only be concerned with profits, and what we saw was jobs going overseas, and the senior management getting rewarded, the price of the stocks being rewarded, and their compensation went through the roof. So we have this income inequity now that we've never seen before, and the crushing of the middle class towards poverty, and the 1% owning so much wealth. And what is, the classic theory was that we would, help a company, bid up its stock and it would expand and it would hire more people. We haven't seen that in decades. But what's happening in the economy now, and I keep being bewildered by people who say that the economy is poor. The economy is doing tremendously well. The unemployment rate is at 50 years low and maintaining it month after month after month. And people are quitting jobs with impunity because they feel like they can get another one, because there are jobs out there. We're adding jobs every quarter, every month, every quarter. And the companies are reporting record profits. So the economy is booming. And so what the Fed has been doing is panicking, in my opinion, and raising interest rates, which has been very punishing. It's punishing to the nation for its servicing its debt. It's punishing to the individuals. You're trying to buy a home now. I don't know how people get started with mortgage rates this high. And that's where a lot of the unhappiness comes when they're reporting they're young people trying to get started and they can't buy a home. It was a very difficult struggle for me 50 years ago. Well, I might be exaggerating, 30 years ago, that I bought my first home, and I was lucky because the company I worked for was doing so well. I was really well compensated. They matched my contributions to the company by 6%. So I made at least 60% every year. And on top of that, the company was going up. So I was able to cash in and get a down payment for my first home. But I'm not sure how people get started today. And home prices in the San Francisco Bay Area have skyrocketed. And I think when we bought our last house 25 years ago, I thought that they added an extra zero by mistake. It was unbelievably expensive. But it turned out to be a great investment because it's only gone up. And I don't know when this is going to change, but I think what's going on in that now that we really want to be conscious of is the chances of a soft landing and the Fed reducing interest rates has increased. Everybody was so skeptical for the last 3 years. All I heard was the recession, recession, recession. Nah, it looks like we're going to pull off a soft landing where the economy keeps going well. It's not overheated. That was never the problem. The problem was the breakdown of the global distribution system due to the pandemic, to COVID pandemic. And prices went up. Now companies are finding out that people will pay that for their products, so they're not going to lower them. But they're not going up anymore. Interest rate is really leveled out. It's around 2% now, which is what they want. That's their target. So inflation is not an ongoing problem. It was a problem, and it's now not a problem. But companies are not going to lower their prices, and people are going to get used to paying it, and it's not going to be a shock anymore when they go to the grocery store, and everything is going to be okay. But what does that mean for your investment chances? Well, the record profits, I think, are not going to be sustainable. I think the stock market is not going to continue to climb like it has been. But I think the main thing that you want to look at is companies that don't have debt or have very little debt. Because companies with a lot of debt, they're paying a lot of interest on that debt. It's going to be very hard for them to overcome that. So that's what I'm looking for now in individual stocks. And I am a believer in both what Milan says, buy the American economy as a whole, and what Sasha says is, you can pick stocks that are good companies and are going to maintain their earnings. And this is what based on experience, your intelligence, and the track record of the companies. And if you're sure that they're going to maintain their earnings, it's not that risky. Um, but there's always that element of risk. So never play with money that you can't afford to lose. Never invest with money that you're going to need to pay rent. Always invest with money that's disposable. And if you have disposable income and you enjoy buying stocks, by all means do so. It's fun. I love being able to look at my phone and track. Like today is all green for me. It's because I picked stocks that are doing well today. Some days I have a lot of red. It's not as fun. But it's green today, so I'm a happy camper. And I still am bullish on the market in general, but I go by sectors, and especially I've been a big fan of the semiconductor sector for a while now, and I still am because it's a matter of national security to bring the semiconductor manufacturing and distribution within the U.S. borders and not rely on foreign allies for this because foreign allies change. And, we really have to be conscious of this, especially when it comes to semiconductors, because they are powering the technological change of the future. Thank you, Sasha.
Thank you, Jim. When Milan mentioned my method of picking the right stocks, but I'm doing that not to buy them. I'm looking at them to sell. Cash secured foods. I don't want to buy anything. I've learned that 40 years ago
May,
from a
may I
stock.
say a few things at
Yeah,
this point,
yeah,
James?
absolutely.
Oh,
You
sure.
stated that you worked for an excellent company, and the company was Charles Schwab, right?
First, it was AT&T. That
Now,
was the company.
if if you take a look at SEC actions, that is the fines that companies have been paying for misbehavior. You look up SEC actions, period, and then put down the name of any bank, Canadian or American bank, you will see the millions that they budget for to pay for misbehavior. It does not apply to Charles Schwab. It does not apply to Warren Buffett, but it applies to every other bank, Canadian or American. The other thing is you were talking about the difficulty that young people are facing today. Today's young people stand to inherit more than any other cohort in history ever has.
Yes.
So how bad can that be?
If you're one
Uh,
of those, yes.
Well, I'll tell you what bad it could be because people today live way much longer. So these kids, they will have to wait and wait and wait. And if their parents will will live until they're 100
yeah,
years old, like
yeah,
did Kissinger and many others, like this.
My mother is 96.
Yeah, so you may be in your 70s when you finally will inherit anything. And if you don't have such good health as your parents, so maybe you will have a couple of years to enjoy this
yeah.
inheritance. It's not a good proposition, at least not to me. Um, okay, what I mentioned before is that I've learned from a stockbroker many years ago the main thing is not to buy stock, is to sell stock. He explained to me that I'm in a business to sell, not to buy. So I came a long time ago to the conclusion that normally people buy and then sell. I would like to re-engineer that process. I would like to sell and only then to buy. Or maybe that will expire worthless, it's even better. But however, the main thing is to sell because you have infusion of cash. I sold three cash covered puts on Nvidia May 17th, 24 strike price 480. I was paid 5,100 for each put. We are talking about well over $15,000, which most likely I will keep it. If not, I will buy it back at profit and will sell even more puts later on. In fact, I may not. I don't even have to wait until expiration date. I can do it. Let's see, in January of this Nvidia will probably go to 550 a share. So I will buy it for next to nothing. I will buy back this puts that I sold. So this is what I'm looking for. And then why would they care about S&P 500 and the people? You know, last Sunday, it was a social party that I attended, and there was an old friend of mine, and he was claiming he's investing in private mortgages. So he is talking about 45 minutes about how he invested in this mortgage and he's got 7.5% on this mortgage and 8% on this mortgage and 8.5%. And then when I came over to him, he's asking, Sasha, how are you doing? I said, well, I can reply two ways. One, I can say, okay, thank you, I'm doing fine. Second, I can tell the truth how I'm doing, but I'm afraid that you will be very, very upset and for a long time. We choose now for me which one would you like to hear from me. Uh, he was quite astonished, and he said, "Okay, tell me the truth, how you're doing." I said, "Okay, I'm doing 240% net profit for last year. How about that?" Oh, what did you say? You make mortgage 7.5%? What is it, annual or a month or what? What are you talking? And you you have audacity to open your mouth and tell people about this garbage. What you're doing?
Ooh,
Oh, I enjoy, but look, if he would be quiet about it, I'd say, okay, so you can enjoy your life and just get on with it. But when he's talking about, like, say, dozen of people, and he's aggrandizing himself, how he's made 7.5% here and 8% there, and people, um, I, I, I don't know much about these people. Maybe maybe they're also investing in mortgages. Who knows? So when I said that, you know what? All people in that party were quiet for the rest of the evening. That's what happened. Everybody was just quiet. And I didn't know how to help them get out of their misery, to tell you the truth. So I was also quiet, enjoyed my dinner and desserts and so on. Then we left. That's the end of story. How about it expiring? I just, at that moment when I said so, I enjoyed a recognition of the achievement in the investing what I made during the last year and planning to do even better in the coming year. Actually, I'm planning to, if everything will be according to uh, my predictions, by mid-January, Nvidia stock should be 500 a share at least, maybe more. So if that's the case, then I will achieve $250 net return for the last 14 months, a little bit more than a year. So I started last October, so give or take 14, maximum 15 months to 250, maybe even better than that. So that's I perceived it's a great achievement. I'm very proud of it. I
Yes.
I don't care about Wall Street, whether it's a friend or enemy, because I don't interact with Wall Street. Okay, I have this discount broker that I'm paying commissions for executing my trades.
And the commissions are small now compared to what
Yeah,
they were.
495 per
Mhm.
trade.
yeah.
There is a trade of $150,000 that I'm doing. and I'm paying 4.95 commission. It's negligible. I don't even count commission for
Yeah,
whatever it's worth because it's a tiny fraction of the value of trading it.
ignore it. Yeah.
Yeah, you might as well ignore it. It really doesn't matter. The only thing what I should not ignore is because I'm operating. It's remember I told you that I don't have any margins on my core account, but on this one trading, yes, I do. So when I'm going all the way and I want to use all the power available to me, sometimes, of course, I'm going really on a verge of available margin, and then they charge me mm, about 12% annual interest rate.
Yeah.
So that on say 150,000, even sometimes $200,000, that represents quite a bit of money. So I have to be mindful. Of course, I'm winning more than enough to allow myself to pay this interest rates, but that's a little bit what I may not be 100% happy about it. But
Now,
it's
Sasha, let me ask you a question, and I
yes,
have a general comment afterwards. But the question is, we're in December, and what we see often is people that have like are managing other people's monies. They're selling in December, or they're taking actions based on being able to report a certain return for the people their investors for the year. And so there's a lot of activity in December that is not rational based on the stock going up or down or what they predict, but basically covering their you know what for their quarterly reports or annual reports. And then in January we see a lot of buying activity. And so how do you ignore that from your point of view, or do you take that into account?
I do ignore it. I'll tell you why. You see, even like 20, 30 years ago, the stocks were much more stable. They could still fluctuate, but to much lesser degree. So let's see, you could buy stocks, let's see, at $40, so it went down to 35. Okay, so you have a small loss. Okay, so you lost, and you deal with that with your accountant or so on, and then you're buying back the stock in January, even for $40. You don't care because you wanted to report your tax loss and so cover profits in some other stocks here and there. Today, stocks are so volatile, and because of electronic trading most of the time and so on, the stocks are going down so quickly and so fast that you would be a fool to keep your stock losing position until December and sell even at a bigger loss than if you would sold it in September or October or so on. So if you're following the strategy of selling as soon as you're losing 7%, and never bring up money for maintaining of the margin call, you should be out of your losing stocks well before December. So then you can still report for tax losses on your annual income tax return, but you don't wait until December. So I noticed actually that lately December is becoming a very good month for the stock market,
Mhm.
surprisingly, because people are already starting positions themselves for upcoming January rally. So
Yeah.
if January economic situation is good and okay, you're doing fine, and you can maybe even start buying in December. That's what I noticed in the last few years. What about you?
Interesting. Yeah, I agree with you. And the comment that I was going to make was it's very interesting because Milan, can you hear me now? I don't think he can. But Milan also says that he's in the business of selling too. And so it's interesting that you both have that approach. And it's never been my approach. So I'm learning from both of you on that.
Question. Is the December and January transactions, are they taking place because of tax considerations?
Yes.
Now, Warren Buffett said that in more than 60 years of investing, he has never seen a good deal not go through because of tax consequences.
Mm.
totally ignore tax consequences. Don't pay any attention. Just make sure that you're buying what makes sense. Like
Warren
Sasha
Buffett
keeps
said,
saying, there's not enough common sense out there.
Warren Buffett many times said that he never sells, he's only a buyer of stocks. And he is buying this and that and that. All of a sudden, months later, he sold this stock and that stock, and he's out of this stock just as well. So
Yeah.
all of a sudden, what is he a trickster who is trying to trick all these people who are following him religiously? I don't know what's the trick there. What's so interesting? I don't follow Warren Buffett to tell us the truth, and I don't care much about what he's doing and what he's suggesting other people to do.
But
But
you
a
know,
lot of people follow.
Sasha, you and I both were following Nvidia, and also I was following and investing in Taiwan Semiconductors, and I noticed at one point that Taiwan Semiconductors, it's gone quite a bit higher since I've owned it, took a little dip, and then I researched it, and Warren Buffett had sold it. So what you're saying is true. This buy and hold is he's not practicing what he preaches.
Absolutely, absolutely. So I don't.
Warren Buffett now is 93 years old, and a lot of what's taking place at Berkshire Hathaway is being done by people other than Warren Buffett. There is Greg Abel, who is likely to
Yeah.
take over when Warren Buffett retires, and he is making a lot of these transactions that are unrelated to what Warren Buffett is thinking. Now,
Agree.
Sasha doesn't have a very high opinion of Warren Buffett, but his record is unmatched over a long period of time. When you take a look at some stocks that have done superbly well, like you talk about NVIDIA and so on, you're not talking about 40, 50 years. Over the period of time that Buffett has been involved in investing, his record is unmatched, including your market wizards.
Attention.
None of them have been around
Is
for the
not
40 or 50 years. Yeah.
Warren Buffett is not part of this book, and this book was written 35 years ago. He's not part of this book. So much about Warren Buffett.
Well, I would hope that I do as poorly as Warren Buffett has done.
Jim, there is no
Yeah.
mystery about what he's done. He was buying 55 years ago stocks like Coca-Cola and IBM and a handful of other stocks and just kept it. There is no mystery in what he was ever doing. And the mysteries happened just in the last few years when he started suggesting he's buying this stock and he building up enormous position in Apple. Apple is number one stock in his
Yeah.
selection yet. And then you look some other reports. Oh, he sold millions of shares of Apple last month and so on. And okay, maybe he already made some money, some easy
Yeah.
money.
And as Milan said, he's delegated a lot of that now.
Yeah,
in
yeah,
advance.
but except you have to understand that with his enormous capital base, neither of us or even other fund managers can follow and do what he's doing
That's correct.
simply because there is no capital available to do that. And without capital, everything what he's preaching, what he's doing, what he's trading, and so on doesn't make any sense. Because his position in Coke, for example, when he keeps it for 55 years, compound interest, the dividend payments, and so on in 55 years, that compounds to enormous fortune.
Yes.
Now, I'm just talking about one of his positions. Now, neither of you or other fund managers, they cannot come back 55 years ago and start accumulating uh, the Coke stock. It's
Mhm.
impossible. So
Right.
whatever is going today in the market, it's a completely different animal. It's a completely different approach. And study and follow what Warren Buffett is doing
Yeah.
doesn't make any sense. Period.
I agree with that. And the stocks now are more volatile than in the past.
Absolutely,
It-
absolutely.
yeah.
Even Coke is more volatile than it was 55 years ago. So again, you can study it, you can read. You probably will be much better off to read Adam Smith book, or Huntington, The Clash of Civilization. It's much more interesting reading than study whatever Warren Buffett is doing, in my opinion.
But I love the fact that you're both selling because Milan, correct me if I'm wrong, but I think that your Monday morning millionaires are buying puts and or are you selling puts and so you're in the business of selling as well.
We never buy derivatives,
Yeah,
only sell derivatives.
right.
Why do people buy derivatives? They buy derivatives because the enormous leverage they can get if the security goes up. So, for instance, I don't know, SPY now is trading at about $450 a share. You need about $45,000 to buy a board lot of SPY. A lot of people don't have that kind of money, but for a fraction of that, for a couple of $100, you can control the same amount of security if it goes up. If it goes down, you lose 100% of your investment. And that, by the way, Wall Street touts as a benefit. You cannot lose more than 100%, which is what happens very often with sellers, sorry, with buyers of derivatives. Only sell derivatives is what we do. Yeah.
So you're both
Okay.
sellers.
Sell, sell, sell.
So.
That's what it's all business all about. Collect, collect, and collect money,
Yeah.
Because at the end of the day, even when you have stocks and they're all green, it's indicative that someday, sooner or later, you have to sell them in order to realize your profits.
Absolutely correct.
You have to sell. You cannot allow yourself fall in love with stock. No, all you need is the stock is a like an instrument of your trade, and that leads to your profits. So always remember, at the end of the day, cash is a king. Everything what you're buying and selling is there to generate more cash. At the end of the day, cash is all what matters.
And preservation of principle. That's one of the
Yeah,
things that
preservation of capital. That's incredibly important. So as soon as you bought a stock, it's in green. Okay, you can keep it longer, or you can sell it faster, just generating some profit. But when it turns down in red, this is a horrible signal. That means that you've
so
stepped your limits. You missed your chance to sell a profit. So just sell it now. Don't wait until it will turn around into green, because it could continue to going down. Then you're talking about, then you're looking at 7% rule, and you don't want to follow the rule. You say that it will still recover, and it's not. And then you're going into big losses. And
well, I
that's
believe in discipline, and I have not yet adopted your 7% solution, but I do believe that it's wise, and I am thinking about modifying my behavior in the future for that suggestion. So I appreciate all the contributions you guys have made to my understanding
okay.
of stocks.
Jim, thank you so much. Milan, thank you so much for today's show. I really enjoyed your comments. And Jim, thank you so much again. And have a successful week of trading. And we'll see you next Wednesday, same place, same time. Thank you so much, everybody. Bye bye.
Thank you for inviting me. See you next
Bye.
week.